Hello, welcome listeners and market participants. Thank you for joining KBRA's European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I'm joined by Ken Egan from our Sovereign Ratings team. Today we will be covering the topic of labour markets in the euro area. Employment markets have tightened substantially over recent years, particularly in the aftermath of the COVID-19 pandemic. This largely stems from a lack of supply, trend exhibited across many global markets. From a credit perspective, low unemployment is a positive and reveals efficiencies in the economy. A strong labor market can also help weather economic slowdowns in times of higher interest rates, but tightness of supply can subsequently fuel underlying inflationary pressures and negatively impact growth. The headline unemployment rate can also be misleading, especially if it reveals shortfalls in employment, labor force participation, or elevated vacancy rates. In a recent report on KBRA.com, we covered the topic of supply of workers in the euro area and the related challenges for Europe's macroeconomy. Welcome, Ken.
Thanks, Gordon.
So let's shed a little more light on the topic of employment here in Europe. So what's exactly happening in the European employment market? Why has it remained so strong?
Yeah, so I guess the labour market has tightened significantly in recent years, and this was accelerated through the pandemic period. Essentially, what we're dealing with is a supply issue within the labour market. The lack of workers to fill positions and the fact that the labour market cannot keep pace with market demand. There's a couple of things to note here. First, years of low rates and free-flowing credit coincided with the COVID pandemic. And so thanks to fiscal intervention to support the economy and a build-up of household savings through that period, the recovery was very strong through 2021 and most of 2022. I guess more generally, in recent years, fiscal intervention has been a constant, from energy subsidies to COVID-related payments, tax breaks, and business incentives. The point being, economic activity kept humming along. And even more recently, when inflation took hold and we had several interest rate hikes from policymakers, which are still feeding through, you still have these factors I just mentioned underpinning demand. Separately, there are reasons why the sheer supply of workers has fallen in recent years. Early retirement through the COVID pandemic period, upskilling amongst workers, a slowdown of migration to Europe, and changing demographics. These are all factors influencing supply within the labour market. So it's a case of demand within the marketplace versus the lack of supply within the labour force.
Thanks, Ken. So what is labour market slack and why does it matter?
Yeah, so it's this idea that you have a lot of labour chasing fewer jobs or less demand in the market, thus giving employers an edge as they can offer lower wages through competition for those jobs. And this is generally the case following the global financial crisis. As economies were slow to recover, demand was slow to pick up. You had high underemployment, which was higher skilled workers and lower skilled jobs. And if we look at slack as a percentage of the extended labour market in the EU, we see that in 2013, 10 years ago, this was 19.6%. And in Q2 of this year, it had dropped to 11.2%. So a big change in that period. When you drill into it, you can see drivers like underemployment, which I mentioned, that averaged 3.3% from the period 2010 to 2019. It's now 2.4%. While over the same period, you had people that fall into the category of available but not seeking work drop from 3.6% to 2.5%. So things got tighter when demand picked up. Another way to look at this is vacancy rates or jobs postings. More recently, we have seen employment grow, unemployment decline to record lows, but at the same time, job postings rise. Slack is being condensed. Essentially for Europe, the vacancy rate has doubled over the last 10 years, while the unemployment rate has halved.
So what are the economic challenges to this current employment situation?
I guess, just to be clear, from a credit perspective, low unemployment is a good thing, right? It can shelter your economy from downturns, help with a softer landing in a higher interest rate environment. However, when this is tied to a supply issue, it can then impact inflation through wages and also hamper productivity and growth. So there are downsides depending on the type of labour market conditions. Right now, we've seen interest rates increase through this year in response to rising inflation. As such, credit to firms has dried up and it has become harder to sustain weaker business models. This has prompted a slowdown in investment, planned expansions, and demand, although not as much as central banks might have hoped. The labour market has loosened to some degree lately, but remains tight relative to its recent past. The lack of supply of workers is at the heart of this tightness. One of the main issues in this type of environment with already high inflation is that wage pressures from this tight labour market sustain price growth. We've already seen this in the euro area. You can look at the percentage change of negotiated wages. It's currently just shy of 4.5%, while that was below 2% in the pre-pandemic years. And for a lot of highly rated European sovereigns, wage growth is now double what it was in 2019. Separately, then, you can see that productivity can decline from two angles. One being the channel of unmet demand, but also through lack of competition.
So, given that situation, how are governments across Europe reacting to this?
Yeah, there has been responses to this across Europe. If you take Germany, for example, it announced a new Skilled Immigration Act to help alleviate supply pressure, but also specifically tackle key sectors where skilled workers are lacking. This act enables overseas workers who hold a degree and have experience to quickly integrate into the economy, ultimately aiding productivity. The EU has launched its new Blue Card, which aims to further ease labour market tensions. And you have other sovereigns such as Spain, Italy, Portugal, and Finland, among others, who are actively pushing initiatives surrounding work permits and visas that break down barriers to enter the EU workforce in a more formal way. We've also seen employment changes and labour market reforms tied to the EU's Recovery and Resilience Facility funds across various sovereigns. In Italy, for example, changes to employment contracts and new hire incentives. One of the big themes, however, is changing demographics. The issue of demographics was once deemed a long-term challenge facing Europe, but is quickly developing into the most prolific threat to labour market supply. Germany's old age dependency ratio has increased to 35% last year from 22% in 2000. France recently agreed to change its pension age as it faces more immediate demographic risks. And Ireland, the EU's fastest aging population, its old age dependency ratio is projected to increase to nearly 50% in 2050 from roughly 20% in 2020. So as you can see, sorting the supply issue in labour markets is becoming more and more of a priority for governments.
Now, bringing this all down to the impact on credit, what is the potential impact upon sovereigns from a credit perspective?
Yeah, it has been somewhat muted to date. I would say that the consequences of a tight labour market could potentially lead to macroeconomic distortions and generate credit pressure over time. We have seen already that the new macro challenges associated with inflation have caused a 17% deterioration in key macroeconomic performance indicators monitored by KBRA in its evaluation of sovereign credit across highly rated European sovereigns. Higher inflation, which could mean higher rates for longer, could also hinder debt consolidation efforts. This challenge is more pronounced for the highest rated European sovereigns, where the present financing environment is more expensive than recent years. For lower credit quality European sovereigns, the rate environment remains relatively favourable compared to the European debt crisis, even if not as favourable as 2 years ago. Overall, I think the macroeconomic trends here are something to keep an eye on without overstating them. And as mentioned, there are efforts being made by policymakers to mitigate the labour market issues.
Thank you very much, Ken. As we've heard in KBRA's view, current labour market dynamics might help offset recession risk, but do pose certain macroeconomic challenges. Tight labour markets can foster more persistent inflation, which risks keeping market rates higher for longer. An easing of the labour market, driven by supply-side initiatives, could help to aid economic normalization. Various pan-European initiatives are underway, aiming to stimulate economic activity, promote labour market supply, and put the bloc on a path towards more sustainable growth. You can find greater detail in the recently published report on our website. Make sure you are registered to receive our latest commentaries and have subscribed to our podcast, and of course, have given us a review. Reach out, engage with our experienced analysts, and thank you very much for listening. We look forward to bringing you more conversations in European credit. Best of luck to you all out there as we navigate through this challenging environment.